you guys hear me okay?
I got you. Troy. And with the late start, apologize for Zoom getting us again. But with the late start, we're just going to jump right in. I think you know the topic. I think you know what to talk about. So no introduction necessary, right? Troy from Eckard, and we'll just toss it over to you, Troy. I'm going to give you sharing permissions if you need to share.
All right. So basically, if I make it correct, most of your listeners on today are either not familiar with oil and gas mineral rights or the oil and gas sector. They're pretty much looking at different ways to create passive income. And so this is more of a low-level introductory about what the space does, what the pros and cons of it are, and keep it at pretty much a high level at this point, correct?
Yeah. Or I know that there are some that are just kind of curious about our passive investors, but are curious more about oil and gas in this particular too. So if you want to kind of progress through the basics up through more intermediate and advanced, we can do that.
Well, what I'll do is I'll start with the basics. I'll kind of do a macro on the industry itself. You guys keep me on track with time. I can talk a lot, so we want to make sure I don't run overboard. But thank you for the introduction. I'll just do a quick little overview. So I'm Troy Eckard. I'm the CEO of Eckard Enterprises out of Dallas, Texas. I started my career in 1985 as a oil and gas registered licensed broker representing high net worth investors around the United States. And my whole purpose in what I've done and what I tried to accomplish the last 37 years is to become an expert in what I would call the midstream and upstream of oil and gas. And what that means is simply that just like in regular real estate, you have raw land developers, you have project developers where they're building multifamily apartment complexes or industrial parks or residential developments. And then you have downstream of that property managers and those investors that want to have existing proved producing assets, and they don't want to take the risk of raw land development or construction. Oil and gas is traded the same way. What we basically have is an industry that is either oil and gas exploration and production. We then have the midstream, which is the actual part of the industry that collects, transports, and processes all the raw mix oil and gas that's produced from the wells. And then downstream would be all the distributors, the gas stations, the gas utility companies, et cetera. In my case, since 1985, I have focused exclusively on the industry itself. And the industry from itself being the upstream, meaning where the oil and gas is actually discovered. It's really important for each one of you to understand that this is a very complex industry, but the complexity is not necessarily any more complex than stocks or bonds or options or cryptocurrency or even real estate. It's just that it's not so easily to obtain information. And so when you think about oil and gas, I want you to think of it this way. Oil and gas really is real estate. If you drill in a well and you don't do it through a partnership, you actually own a deeded title participation in a well that's assigned in a courthouse, or it should be. If you buy oil and gas mineral rights, which I'll explain the difference in a second, it is a piece of property. It just happens to be below the ground instead of above the ground. But again, it's deeded and titled real property. So the fundamentals of oil and gas is when you actually look to secure an interest in a mineral lease or mineral right, you're effectively buying real estate. Now, like in any investment, it's always going to boil down to who you're doing business with and the way in which that investment is structured. So we'll cover that in just a second, but I'm just saying that up front because the oil and gas industry is quite lucrative. It has a lot of potential and a lot of opportunity. But the bad actors, those that want to get you involved in oil and gas and they don't want you to know how it really works, they're going to mask the ability for you to understand it. They're going to mask the ability for you to successfully navigate oil and gas because they really themselves don't know what they're doing. They don't have an expertise. What they figured out is there's a high demand between affluent or high net worth investors who seek to own oil and gas interest or assets. They want to own it. They want tax write-offs by participating in drilling. And so they use that affluent appetite from affluent wealthy investors to say, I've got oil and gas, enough of a knowledge to present it in a package that looks pretty to unsophisticated, unknowing investors who desire to be in that space, and they want tax write-offs and they want passive income. That gap is wide. The gap between wanting it and understanding it is massive. The bad actors in our industry, they use that to their advantage. And what they essentially do is they keep you dumb, they keep you separate, they keep you spread out so you never figure out what's going on. Absent the bad actor, absent the crooks, absent those that are selling illegal securities, now you say, now I've got a legitimate sponsor, somebody who knows oil and gas, who's following the law, doing it correctly, and the appetite between somebody who has money they want to invest in the oil and gas space. Now what you have to do is you have to rely upon that expertise. And that's no different than in apartment complexes or real estate investments or stocks or financial planning. There's only probably 10 or 15% of any industry that has true expertise. Well, since I've been in the business since 1985, my 800 number for my company has been around since 1991. I would be willing to say that my 800 number has probably been around longer than most principals that are out selling oil and gas. They're 30, 35-year-old individuals, and my 800 number is probably as old as they are. The point I'm making is this. This is a very lucrative industry. It has a lot of moving parts. It has a lot of opportunity. It's almost like walking into a buffet and saying, I've got crab legs, I got filet mignon, I've got the best desserts in the world. Where do I go? How do I start? What's the best value for the limited capital that I can invest? In my case, what you're going to get the advantage of with Eckard, or specifically in what I call the mineral rights acquisition space, where you're truly buying mineral rights below the ground underneath producing wells with major operators. The advantage is that I've given you 37 years of my expertise to say, I pretty much have tried everything you can think of in oil and gas. And I've come to the conclusion after 3.5 decades, the lowest risk, first in the food line, first one to be, first at the top of the food chain, is mineral right ownership. Because every oil company in this country that drills any oil and gas well on private land, which is probably close to 89% of all wells are on private land, the other 11% are on state and federal. Of that 89%, whether it's Exxon, Occidental Petroleum, Chevron, Shell, it doesn't matter what company, they all first go to you and I, a private mineral owner, and say, we want to lease the rights to develop your minerals. You can keep your farm, you can keep whatever vertical structures you have, you can keep your air rights for communication, you can sell air rights separately, you can keep your surface rights and do whatever you want. We, the oil company, we just want to develop what's underneath it. We want the natural resources that are there. In this case, these particular lessees are oil companies only focused on one thing, that's oil and gas. So because of that focus on oil and gas, there's a very limited amount of opportunity in the United States. There's only so many places. The dinosaurs died. The hydrocarbons were deposited 100 million years ago. So it's in states like North Dakota, Ohio, Pennsylvania, Texas, New Mexico, Oklahoma, Colorado, Wyoming. I mean, it's just certain states, and it all has to do with just geology, where the geological events occurred 100 million years ago that allowed all the dead plants and animals to be buried, and then they were covered up by earth, they were cooked by the magma in the earth, and all that dead plants and organic material eventually turned into what we know today as crude oil and natural gas. So we have a very geographically specific area in the country where buying or owning mineral rights specifically for oil and gas extraction exist. You're not going to find it in certain states. There's just no oil and gas. The geology wasn't there. Because of that, with modern technology such as the internet and everything that used to be filed by paper in the courthouse, over the last 10 or 15 years, all that information has now been uploaded onto a online internet accessible site. And you now, as an oil buyer, oil and gas company, if you're spending the money, you're investing the capital in R&D and technology, I can now go to virtually any well drilled in the United States in the last 120 years, and I know exactly how it was drilled. I know all the records and data. I know what zone or formation they drilled in. I know how well the well produced. I know which operators are good, which ones are mediocre. I know where there's mechanical failures. I have all that data online at my fingertips, or my team's fingertips, to tell us where we believe the best oil and gas opportunities are for us to go make investments. So it's like kind of having a macro data set that gives you the top 30 largest cities in the country. And within that data set, you can look at the best price per square foot, the best rental values, the best construction costs, the most friendly as far as coming into getting entitlements like annexations, et cetera. So you have all this data, and you now compress it into one data source and then you add the skill set behind it, it gives you an advantage we have today that we never had even 5 or 10 years ago. So we're at the cusp edge of absolute technology being maximized to lower the risk and increase the value of successful oil and gas investing. Now, my company pretty much has 3 different investments that we have. We're invested in a natural gas pipeline. We're the second largest natural gas pipeline in the Gulf of Mexico. We bought it 13 years ago. We move 27% of the natural gas in the United States. I'm a co-owner, one of the largest owners. I started the company, and it's been around for 13 years. The second thing that my company has done is we have been drilling oil and gas wells in basically 13 or 14 states since 1985, well over 1,000, 1,500 wells. We currently have interest in close to 2,000 wells, and that is as a result of drilling, exploration, acquisitions, and now because we buy mineral rights. All of that in pipelines and drilling has been good. It's been good because it was the way for you and I as small investors to participate for little bitty incremental positions or ownership with major or sophisticated oil and gas companies. The problem with that particular participation is it can be very risky. Why? Especially in the drilling side. This country was running out of oil and gas. Without going into the history of that, all I can tell you is where we were in 2008 when we had record oil prices at $145 a barrel. Our tank was down to less than a quarter full of potential oil to supply this country with the oil and gas that it needed. We were running out because we were drilling more dry holes than successful wells. Technology was not advanced. We did not have fracking. We did not have horizontal drilling in the way it's being done today. Because of the success of technology and because of the success of the drilling techniques and these really brilliant engineers, we discovered that there was these massive below the ground buried Grand Canyons. These Grand Canyons are like today's Grand Canyon on the surface, except they got a mile of earth or a mile and a half of earth that's been compacted over 100 million years and trapped all those oil and gas molecules in the ground. The magma in the earth has cooked it, and they're sitting there just like a shaken hot 3-liter Coke ready to explode. So what I did about 5 years ago is I decided, because of my age and because I've been doing this for 35 years, I wanted to take a step up, and I wanted to try to get to the position of eliminating loss of capital. I got tired of drilling. I've had a lot of good results in drilling. I've had a lot of dry holes. But for me personally, I looked at the landscape and said, wait a minute, because of technology and because these massive, brand new, undeveloped shale basins have been discovered, now there's over 100 million acres, 100 million plus acres in the United States that has a 99% chance of finding oil and gas when a well's drilled, enormous amounts of quantity oil and gas. I just got to figure out which lessee, which oil company is going to drill and develop which minerals in the very best places. And that's where I want to buy my mineral rights. I want to be with the best real estate developer. I want to be with the most prudent property manager. I want to be with the best marketing company that's going to get maximum rent rates for that condo that I'm selling or that commercial building. In my case, my pool of potential operators, oil companies that will be lessees, is very small because there's not 5,000 oil companies. There's probably 350 oil companies that are worth $100 million or more. So I have a very, very finite group of potential oil companies that will be lessees and operate and produce and drill all the wells. And they will do that on minerals that I buy or you buy with me as a participating partner. The key to this is that this is not something you can do. This is not something you can do easily. It takes 3 decades worth of expertise to be able to know how North Dakota compares to Texas or Oklahoma. The state rules, you've got several different skill sets within a team. You've got geology, you've got engineering, you got land, you have accounting, you have title work. If you can bring those components together and you can do it in a way that aggregates that intelligence, that intellectual asset, and then you combine that with this massive leading technology these oil companies are using, you might have a perfect combination for the right asset class. Now, I can tell you, many of you are just like me. You probably are sitting in a position of, you're probably middle to latter part of your career. You may even be retired, and you're saying, I just want a safe place to put my money. I want to know it's a place where I can have reliable, consistent cash flow. I want an asset that has, better than a 90% chance I'm never going to lose my principal. I may have an adjustment in my rate of return, but I want to never be able to be exposed to losing my capital. If I could get back 30 years of lost investment dollars, I'd have been retired 15 years ago. But when you're young and you're making money and you're running through your career, well, sometimes taking a step off and being in a bad investment is like, that's all right, I'll make it up next time. As I moved into my late 50s, it was real simple for me. I wanted, in my mind, virtually as close to 100% safety as I could get. I wanted to know that the people, the company, the tenants that were going to develop the assets I own were Fortune 500 billion dollar companies. I wanted to know that it was the greatest, latest technology. I wanted to know that the product that I own had almost 100% consumption, because literally every person in this country, including the homeless people, are using a barrel of oil every day. The cardboard they lay on, the cell phones they have, the credit cards they have, the debit cards, the whiskey bottle they hold. And I'm not being funny, but I'm being serious. Everything we use today, everything behind me in this room is made from, transported by, or a derivative of a barrel of oil. I'm not worried about EVs. I'm not worried about solar and wind. That's all BS and nonsense. I don't care what anybody tells you. It's nonsense. So with that being said, really, what is the opportunity today? Today, this country is running about 700 drilling rigs in the United States. Now, that's pretty pathetic. We have 350 million people in this country. We're running 700 drilling rigs. We're the #1 consumer of crude oil in the world. We currently produce 12.2 million barrels a day, okay? And we use about 20.5 million barrels a day. Even if this recession gets deeper, we are in a recession, by the way, and it gets deeper, and we lose 1 million barrels a day because people pull back on demand, 1.5 million, 2 million barrels a day, we're still 37 to almost 47% short of producing what we consume. So we are net consumer, no matter what we do, which means if we have a finite number of drilling rigs that can drill wells, and we're drilling as fast as we can, there hasn't been a new drilling rig made in this country in over 6 years. We are out of equipment, we're out of manpower, we're out of rigs, we don't have the capacity. So the whole United States believes we can just go drill, baby, drill, when the truth of the matter is we are at maximum speed. With the current pullback in commodity prices, these oil companies are going to take record earnings from last year, and they're going to start to slow down because they anticipate the fourth quarter this year to be less money to spend. So they're taking a conservative, defensive approach. I want you to know how all this ties to what we do for a living. All right. And let me explain it very simple. We go to, in our case, 2 areas in the country that we believe are the most economical. Number one, we like the Anadarko Basin in Oklahoma for about 3 or 4 reasons. First and foremost, it's large, it's easy to find, it's extremely prolific. A lot of oil and gas is extracted for every single well drilled, and it's done at some of the cheapest prices in the country, meaning recovery costs, production costs, discovery costs, et cetera. The second basin that we play in is the Permian Basin in West Texas. The problem with the Permian Basin is it's about 8 or 9 times larger than the Anadarko Basin in Oklahoma, but it also is, it's the Manhattan style property. If I can buy an acre in Oklahoma for $15,000 a mineral acre, it might be $45,000 to $100,000 an acre in the Permian Basin. There's a reason for that, but it usually is tied to more reserves, more formations, you pay more price per acre. The Permian Basin is equivalent to the Saudi Arabia style production. So we always call it in the industry, Permian Basin is Saudi Arabia of America. The Anadarko Basin is incredible. We've been doing it for 5 years. Our average cash on cash return is running well over 18% across 74 portfolios, and it's just getting better. So we're super excited and very happy with the Anadarko, but we believe the Permian Basin is a nice complement to what we're doing. That being said, and I already saw one of the questions pop up, is finding is one thing, extracting it under $50 a barrel is another. That's a cute question, but that tells me you also don't know the industry very well. Because the truth of the matter is, if we drop below a production rate, or the oil companies do, they'll stop drilling, they'll stop producing, and oil will be at $250 a barrel. See, the media has everyone fearful that electric cars and solar panels are going to make oil and gas obsolete. The only way to be obsolete in oil and gas is you'd have to come out with a sign, not made from oil and gas, which means it won't exist. You got to be butt naked on a dirt road using sign language. Otherwise, you're using a barrel of oil to communicate it, walk on, dress in, or create your sign from. So the reality of it is fossil fuels is here to stay. Unless some scientist comes up with a tablet they can put in salt water, we will see oil and gas demand increase. Solar and wind will increase as well. Because why? More industrial use, more babies, more people, more population. The natural consumption of energy is going to grow between now and 2050, let's say 25 years out. But the percentage of growth will be more toward alternative energy, which is a good thing. But oil and gas demand will also grow, meaning that we will actually need more oil and gas in 30 years than we need today. That's not an industry going out of business. That's a growth industry. It's just sharing that growth with alternative energy sources that are coming out. All right. So I believe the fact is that if you truly want to find a reason not to invest in oil and gas, you're going to come up with 100 questions. And even if the 100 answers are satisfactory for your 100 questions, you're never going to participate in oil and gas. You either want to be in it or you don't. You either like asparagus or you don't. There's no in between, right? In this case, I answer, and I have an app that we created called Eckard Insights. Every one of you on this particular break today, this lunch presentation, can sign up to Eckard Insights, ECKARD Insights. When you do, you'll sign up and say, yes, I'm an accredited investor, or no, I'm not. And you'll have access to hundreds of videos and all the information that explains the thousands of questions you're going to ask. But at the end of the day, it boils down to really a simple, fundamental part for your investment. Do you believe that you can acquire a mineral right with a major oil company already producing cash flowing from day one, which is the only minerals we buy, with the idea and the trust and knowledge that somebody with almost 40 years expertise has bought that mineral right, not for the producing well at the time in which we purchase it, but because we believe, and the data and the information and the empirical facts show, one well really is the first, what should be 8 to as many as 80 wells being drilled over the next decade. In other words, think about this. I've gone into a piece of raw land. I've entitled 1 acre and I built a spec home. Spec home's worth $300,000. That's the first oil well. It generates rental income because I rented it out. But now I have 300 acres that I can go and sell additional lots at the same metrics, the same numbers, but because of efficiency, it's going to get better and better. I'm going to build a second, third, and fourth, and fifth house that is actually going to be lower cost to create as far as building it and renting it, and a higher net profit. Okay. So one of the key things is that when we buy minerals, we're not just looking for the first or older wells that are 5, 6, 8 years old. That's buying cash flow. Anybody can do that. What we look at is a macro view of the Anadarko Basin, and then we specifically look at which operators are most efficient, best capitalized, have the highest yield, the highest extraction, the best production, because we're picking the winning jockeys. And then Eckard uses our talents to go in and select those different mineral acres. Let me address a couple of questions. I know some of you are typing as fast as you can. It says, if federal leases reopen for hydrocarbons exploration in 2 years, how will this affect the investment? Zero. They can open up the federal lands all day long. We're still running about 7 to 9 million barrels a day short of what we can produce. The fact is, oil companies have been beaten so badly, they're moving away from federal leases because you have to have lead time of maybe 3 to 5 years to lease federal lands, drill federal lands, and every 4 years with a change of presidency, they change the rules, which makes it incredibly uneconomic. Even the majors have been moving away from federal lands. They're either going international or they're developing on private lands. The next question said, can we focus on qualification criteria applied to benchmark operators? I think your question is, can we focus, meaning can you or can I on the conversation? I don't know what that means, but let's just take it as you mean benchmark operators. The fact is if you have the team and the staff, you can go down and list every operator in every single basin, and you can rank each operator based on a multitude of variables. And those multitude of variables will be, how much capital do they have to deploy? There's no sense in having an entire area to develop and drill if you only have enough money to drill 5 wells a year. That doesn't suit me as a mineral. I want somebody who has enough capital they can fully develop and maximize extraction of my oil and gas out of the minerals that I own. So we're looking at financial strength. We're looking at competency. Believe it or not, Exxon, which owns XTO, is the worst operator. We do not buy minerals under Exxon or XTO. They're large, they're lumbering, they're expensive, they take forever to pay, they don't respond. Whereas the mindset might be you should buy under Exxon's minerals. Absolutely not for us. It's the worst operator we have in the field. We would much rather have that mid-size, $5 to $50 billion company that needs the perfection, needs the results, and they want to extract, rotate that capital, because we want our tenants, the oil companies are our tenants, we're the landowners, mineral owners, we want them to have plenty of profit, plenty of cash flow, and lots of success, so they'll drill that 5th, 6th, 8th, 10th, 12th well. In the basins themselves, you got to have a lot of analytics to figure out who your benchmark operator is. And it takes everything from finances, well performance, extraction, distraction. If I own a big company owns minerals in 5 or 6 basins, you always have to figure out, are they going to take that capital out of one basin and move it to another because they have leases that are expiring? There's a capital reason. There's better pipelines. There's better refinery capacity. These are things that always are moving parts that we have to judge and gauge. But in all of that different peripheral details behind the scenes, that's what Eckard does here, is we analyze that to decide whether we want to be in the Oklahoma Anadarko Basin, the Permian Basin, and once we get there, of all the operators involved, which ones do we believe are going to give us the greatest value with the greatest commitment of extraction of the oil and gas from the minerals that we buy? Bear in mind, as I'm telling you this, for those who don't know, you expose no capital risk by owning minerals. You have no cash costs, zero holding costs. You never are exposed to any liability environmental. When you lease the minerals, or we buy minerals that have already been leased, under that lease agreement, the oil company, who's the tenant, assumes 100% of the liability. When that big check comes to Exxon or whoever the heck it is that gets the oil and gas money, whether it's Oventive or Chevron or Oxy, when they get that check from the oil buyer and the gas buyer, and it's a gross check, the first thing each oil company says is, we don't own it all. That's not our money. We're fiduciarily responsible for distributing. But the top 12.5% to 25%, depending on the royalty payment, goes straight over to a royalty distribution account. The money that's left is the percentage after the mineral owners. That's what they pay all their bills. So because of that, we're never exposed to liability. We have no capital costs, zero holding costs. We get a check every month. I don't care if it was $50 a barrel or $500 a barrel. We get our pro rata share by the number of acres we own in the producing legal unit that we get. Next question, will the investment require an investor be a GP? The answer is no. Eckard does not do limited partnerships. We don't do LLCs. Everything when you drill or you buy minerals is done as a direct purchase sale agreement assignment, which means you own your fractional minerals, you own your fractional working interest directly in your name, tied to a purchase sale agreement, which is managed by Eckard for free. And the reason we do it that way is it allows you to do 1031 exchanges. It's what we believe is best inside of your self-directed IRA. And quite frankly, I don't like general partnerships or syndication because it means somebody created a document that's going to take all the rights and rules, give it to the general partner, and you're going to have no rights. A lot of you are starting to see syndication where they're suspending your distributions, they're changing the rules of the game, they're changing the redemptions, and you're stuck with whatever they change. I've done this for 37 years. I don't like somebody else making up the rules. So the way Eckard does it is we take mineral tracts, we put it into a named portfolio. When you make an investment, you own a fractional share of each one of those tracts of minerals according to how much you invest. Purchase sale agreement signed, it tells you which deeded tracts you own, how many fractional acres you own. We send a check out about 6 months after you invest, and then you get a check every single month, and these wells will last 25 to 75 years. So there's no GP, no limited partnership, no K1s. It's 12 checks, 12 ACH deposits, and a 1099 in January. It's the simplest investment, the most passive investment you're going to make of any kind of hard asset or tangible asset. The next question said, do you have a target term for the investment with a sale of the mineral rights at the end? What are the expected returns? First and foremost, my strategy for the last 10 years has been what I call AML. I want to aggregate assets that are fragmented, okay? I want to let them mature. Maturity is important. It's like filling up an apartment complex or self-storage. You've got to get to a point where you demonstrate the value and the success of that asset maturing. And then the L part is the liquidation part. So many of our investors today, which is over 1,100 high net worth investors, many of them are trained in real estate school to buy, entitle, improve, and sell the next sucker. I can tell you that most of our partners who started that philosophy 3 years ago are now in the buy, let them mature, and then let them continue to prosper because there's no holding cost. It's just pure net revenue. So what we've experienced since 2018 when we started, our first portfolio was really at the end of 2019. We funded it. Since we've done that, our average cash on cash return across all portfolios is right at 18% cash on cash. Now, some of our portfolios are almost 100% paid out inside of 3 years. Most of our portfolios, if you didn't take the last 6 or 7 we did since December, most of our portfolios right now are averaging well over 20% rate of return cash on cash. Again, some are doing 30, 40% per annum and still cranking out like horses. Why is that? Well, in Eckard's model, the first and foremost thing is we have the strategy in our model as follows. Number one rule, do not buy any mineral that's not cash flowing from the day we buy it. Number two, preservation of capital is paramount above anything and everything else. Not losing my money, your money is paramount above anything else. Number three, we only want to buy minerals under the top jockeys, the top operators, oil and gas companies in the basin. So we are very, very sensitive to looking at the very best operators because you can have great minerals with a mediocre operator. They're going to give you poor results of wells. They're going to take forever to drill them. You're going to have nothing but headaches. And what you've done is given the value of your reserves to maybe a B- or a C- oil company that's going to leave a lot of money in the ground, right? The next thing we have is we have a very simple financial target. We're looking to make 10% return per year over 5 years. You give me $1 million, and in 60 months, I gave you back $1,500,000. You made 10% a year. We like to think we're going to target somewhere between 8 and 20% in the first 12 distributions. We've exceeded that. We like to think that when new wells come online, it's like that 3-liter Coke. You've shaken up the reservoir, you fracked it, it's going to have a lot of production in the first 12 to 24 months. So what we'd like to see is our revenue checks come on, they start to kick in. We see these big bumps in cash flow because of the new wells. It comes back down and it levels off. By the time you're at the end of 5 years, in my view, we're looking at returns of 70% to 150% return of principal capital, meaning we look at payout in less than 6 or 7 years for the most part. That's at today's commodity prices. But you got to remember, you're not buying a single mineral acre or fractional acres because of the 1 or 2 wells being drilled today. We're buying minerals that have multiple pay zones, 1, 2, 3, 15 different reservoirs. We're buying it today based on the economics of what we know today. 2 wells are producing, 2 are proposed to be drilled. That's the only value in our model. We know that all the wells around it have already drilled 5, 6, 8 wells in 2 different zones. So we know there's probably another 6, 8, 12 wells to be drilled in the next 5 years. We don't add that into our model. Why do we do this? It's imperative that you, when you ask about a liquidity question, the question always becomes, when do you want to sell? Do you want to sell your self-storage unit that pays for itself in 5 years? You have no more money left and you're at 90% occupancy and those tenants are going to pay for the next 15 years for self-storage. Do you sell that self-storage building? I don't, unless somebody wants to pay me 4 times its value. Finding passive income is incredibly hard. Finding good rates of passive income percentage-wise is next to impossible in this market. If you can find an asset with no holding costs, no liability, no exposure, 0 on the backside, write 1 check, you're done. Never get a bill, no expense. If I can find that and it can pay me out in 72 months or less, and it can last 25 to 70 years, I personally don't want to sell it. Some of you might want to sell it. So what we've done as a company, we built our own app. You can get on computer, you can get on your phone, Eckard Insights. And now in May, 60 days from today, we're going to be introducing what's called a peer-to-peer market, which means I can find out I got cancer. My wife and I are getting a divorce. I just want to go buy something else. I need some cash out of it. It will allow each one of our partners to put a given portfolio on that site into that peer-to-peer market, which says 1,100 other equal mineral rights buying partners. I want to sell the minerals that I paid $100 grand for. I've owned them for 3 years. I made 20% return a year. I want to sell them for $150,000 because of the cash flow, the proven wells, and you post it. The likelihood, in my view, that it sells somewhere between the price you paid for it, including minus the distribution you've already got, and a profit are pretty darn high. Why? Because it's been de-risked. And the more we produce, the more we de-risk it, the more we prove up additional zones, the greater value it comes to me, in my mind, what my minerals are. I would never sell a mineral I buy that, in my view, has more reservoirs and more wells drilled. I would never sell it for less than 1.5 to 2 times what I paid for it, regardless of my distribution. Why? It's too hard to find. We're buying the core mineral acres in the Permian Basin and the Anadarko Basin, never to be had again. It's like buying Manhattan real estate. So for me, I'm not looking at a liquidity, but we're providing that as a tool for our partners because you never know what's going to happen in life. Hey, I've been rambling now for probably a solid 25, 30 minutes. I know that you guys are short on lunch break. I don't want to stop or interfere. If you want to jump in and guide me, what you'd like me to talk about now, I'll do it. I can talk for days on one breath there. I just want to make sure I'm covering what you need me to cover.
Yeah, you did a great job, Troy. And I think that we've answered the questions that it looks like are in the chat. So a couple quick disclaimers. If you've asked a question, it shows as open in the question and answer, and then once Troy has answered it, I move it over to answered. So if you miss the answer, we'll have a recording that goes out. Another quick disclaimer, and I'll put it out there too, is Troy, we have a deal webinar scheduled where we'll go into much more detail about the transactional details. That is scheduled for 2 Eastern on April 13th. So encourage anybody who has questions in the meantime to reach out to Troy and his team. But we'll have a deal webinar similar to this on April 13th. So I want to put that out there. If you have any more questions, please put them in the chat. Troy, we've got until the top of the hour, so you've got 20 minutes if you want. We can encourage people to throw questions out there, but I want to leave it open too. If you have more to discuss, we can wait for questions to come in.
Well, let's talk about what's on everybody's mind, because right now it's got everybody panicked. 2 things are happening. One is, why is oil and gas prices down? Is it going to go down further? Which is why we got the first question about where is producer economic below 50. The second thing is, how's oil and gas going to be affected by the banking crisis? Because I have clients all over the country. And so I get the good fortune, and I have for 60 days, I've been traveling from West Coast to East Coast, north to south, in some of the smallest towns to the biggest towns in the country. And the biggest question right now is, how many of your other investments are going to have wheels fall off, where you have to get refinancing, the banks are going to squeeze, interest rates are higher, occupancy's down, cost of operations and et cetera are higher. So there's a lot of pressure out there right now on many of the investments that we all own. And it depends on when you got in, who the sponsor is, who the syndicator is, how they prepared, and what their philosophy is. So what I've seen the last 60 days is, Troy, two things. What has Eckard done in preparation for a potential banking crisis? So we did a couple of things. About 9 months ago, we decided to split our assets and our cash and our holding accounts to 3 separate banks. All 3 banks we ferreted based upon their loan portfolios, their capital strength, because we didn't know SVB was going to occur. But I got clobbered in 2008. And I've been saying since 2020, you can look at my emails and my recordings. I told my team and my clients in 2020, we're headed for raging stagflation, and we're going to see probably new record price in oil and a recession. And they were like, how could, what are you talking about? Things are going good. We got, COVID's happening, et cetera. I said, no, it's happening. And maybe I got lucky. Maybe I know Nostradamus, but here's the point. Because of my personal experience in how banks respond when there is an extensive long period of a bull market without really true hardcore numbers, I knew a banking crisis was on the horizon. It's just a matter of when. So we split our bank money between 3 different banks. We then put a report out to our partners saying, here's what we did. We've been prepared for this. The additional thing we did is we took out an additional $150 million macro account coverage. And the way you do that is, our bank said, if you'll take a slightly lower interest rate on your cash on account, we will cover all your accounts with this third-party insurance up to $150 million. So we took that, and we have that. Now, a lot of banks either don't offer it, or a lot of depositors won't accept it because they don't want to lose that interest rate. We took it, we accepted it, and what we want to do is tell you 2 things. We fully believe that the banking crisis is helping pull the price of oil down. It's artificially suppressed $15 to $20 a barrel, just like in 2008. If you look at 2008's charts, when the recession started, oil was at $145. Within 6 months, it was down to $32 a barrel. 14 months later, it's back over $90 a barrel. Why? That was a financial drag on commodity prices because banks pulled back their horns. They stopped lending. They became risk adverse, and they also had less liquidity. So they're going to back an apartment complex before they back an oil trader trying to buy 100,000 barrels of oil to deliver to Valero in the month. So lines of credit, your lines of credit at your business, your personal lines of credit, they're going to shrink. These banks are going to pull in their horns and say, we've lent out $1 billion. We're going to figure out how to get back 250 to 350 million. How do we do that? Cut lines of credits, make people put more money down on equity and real estate, cut out any kind of risky investments such as trading in oil. And you know that this is the reason why this is important is 70% of the oil companies out there hedge their oil. They borrow money. They like to hedge to protect their downside. They're coming out at the first of every month saying, we got to sell all this oil on a hedge. Well, there's less traders with less cash. So guess what? You put 100,000 barrels out, no bidders at 75. How about at 72? How about at 67? How about at 62? So what happens is the price keeps going down because these oil companies are forced to hedge if they have loans. They're forced to hedge in order to protect the downside. And the traders know that. So they wait till the price drops. Then they buy the necessary barrels and they get prepared to deliver those barrels at the end of the month. You'll see a spike in the first week for oil of each month. You'll see a spike in the last 5 days of each month, and you'll see a big drop off V in the middle under normal monthly trading. At the end of the day, this is not a economic pullback in the price of oil and gas. It's financial, meaning the financial system's providing less cash and it's risk averse. Economics are strong as they've ever been. We are maxed out at 12.2 million barrels a day, no more equipment. We're giving the United States oil and gas industry is giving 100% everything they have to the supply side. On the production side, we're maxed. On the demand side, everybody says we're going to alternative energy, we're going to wind and solar. If you run the math on it, and if you look at the data that supports it, oil and gas right now, oil prices have to be $150 a barrel or more, with solar or wind being unsubsidized to be equal. If the federal government didn't give away $500 billion in the omnibus in December, not a single windmill, not a single solar panel makes economic sense without a subsidy, which means what? They're trying like crazy to create alternative energy. But at the end of the day, 85 to 87% of all energy is going to come from fossil fuel. If that's true, then whoever owns the smaller number of wells that are being drilled, the fewer number of rigs that are drilling wells, and the fewer mineral acres that are actually being commercially put into production, you own the golden nugget. You own the actual resource that runs this country. So Trump didn't help the oil and gas industry in 2020. He liked $55 oil. Biden and his administration doesn't like fossil fuels at all, so they cut off the capital. I like all that chaos. All that chaos means what? Higher barrier to entry, whichever wells are drilled, and whoever owns the minerals under those wells is sitting in the driver's seat for future escalation in commodity prices over the next 12 to 60 to 72 months. I personally believe you're still going to see oil prices by the end of the year pushing $85 to $95 a barrel. Natural gas is a little bit subdued because we have had warmer winters in Europe and here. But at the end of the day, the whole globe is producing all they can, and we're still going to see a 2 million barrel increase this year in consumption around the globe, but yet we're flat on production. This is economics 101. So I just want to make sure you know that, one, we have thought about the banking crisis. And by the way, in my view, as a 58-year-old guy that's been through this for 40 years, the SVB banking is not the tip of the iceberg. It's the tip of the iceberg. Those 4 banks took down more in federal funds than all 400 plus banks that failed in 2008. That should scare the heck out of everybody on the Zoom. So what my clients are doing, we have almost 1,100 clients. What my clients are doing for the last 60 days, they weren't saying, Troy, what about commodity price and things going on? They were saying, how do we get money out of these banks and put it into more tangible assets like minerals? When's your next mineral portfolio? How do we do it? So keep in mind one thing that we do that nobody else does. In the minerals that are offered to our third-party clients, my company, my team, they've already gone out and bought the minerals. We've cleared them. We cleaned title. We closed on them. We paid for them. We own them. There's not a syndicator, I would bet, that you deal with, not a single sponsor you deal with that owns the asset before they offer it to you. I do that for a reason. If tomorrow, every single client I had says, Troy, we don't want to buy any more minerals. We don't like the way you talk. We don't like your ugly face. We're done. The minerals I have, which is probably $40 to $50 million of minerals sitting here in inventory, those minerals, I am perfectly fine keeping them versus selling them to third-party partners. Well, then why do you sell to third-party partners, Troy? Because here's the reality. When I see a 25 or 15 or $18 million package, I can't show up with $1 million and $1.5 million and say, I'd like to buy 10%, please. Sometimes the sellers are bank trusts, institutional sellers, public companies are trying to sell. And what they want to know is, can Troy successfully make an acquisition? Can Troy buy those minerals with the idea knowing that it's really, really good minerals at a really good price, but without the power of aggregation, the AML part of my financial wealthy partners behind me, I couldn't do that. So we go out and buy minerals using our own cash flow to buy them. We know that we're going to keep 15 to 20% for our personal account, and then we're going to sell the balance of it with a fee that allows us to recover our cost, cover our taxes, and make a little profit. But it gives us the power through the aggregation representing each one of you as high net worth clients and investors and partners to go out and buy minerals we otherwise could not afford or could not buy. This has been going on its 5th year. And one of the things I can tell you is I've got very sophisticated partners. I got geologists, engineers, I've got landmen, I've got bankers, I've got doctors, lawyers, you name it. I've got really, really industry smart partners who've gone out and looked and said, we can't buy the quality of minerals Eckard does at his price. So I've got petroleum engineers as my client saying, I can't find what you've got. That's only because of you, our wealthy clients coming together in a single force. We become the #1 buying mineral owner in the state of Oklahoma over the last 2 years. It's because of my partners. The last thing I would tell you is as follows. If you're looking for tax deductions, you can drill a well, but let's make sure you understand it because I want to make sure I stay within my time frame. The first and foremost thing, a dry hole drilled gets 100% tax write-off. A successful well drilled gets 100% tax write-off. So you've got all these people promoting drilling wells, and the first thing they tell you is it's got a tax deduction, 100% tax deduction. That's the first thing I say no to. If somebody calls me and says, Troy, I've got a well, you get 100% tax write-off. Thank you, but no thank you. Click. Well, why? If you've got to tell me about 100% write-off to get me to listen to you, then you're not really telling me you have an economic investment. You're telling me I'm going to hit your hot button of saving taxes. The way it should work is when you drill a well, You should drill it with the intent, is this a good economical well that's going to make me a profit over 3, 4, 5, 10 years? I automatically get the tax write-off. So I don't need you to tell me that. What it should be is you invest in drilling to get a tax deduction this year, but it's more of a tax deferment because I expect that well to start paying me in 12 months, and I really expect to be 100% paid out in 36 months. So I'm simply using the IRS's money to drill a well in 2023. I expect revenue from that well plus my income next year to let me buy more interest in wells. And over 5 or 6 years, I see this massive growth in my oil and gas reserves and cash flow from drilling. And I'm simply deferring the taxes I owe by reusing that money, adding my income and doing it year after year after year. We're preparing a Eckard working interest workbook that'll be ready in about 5 or 6 weeks. If you want to email me around the middle of May, we'll send you an email copy of that working interest workbook. And my goal is that you can take 10 oil and gas working interest offerings, drilling deal offerings, you set them up, run them through the worksheet, you'll come to your own conclusion. You don't need anybody to sell. You'll know who you want to drill with, why you want to drill, what the economics look like, and it's a very clear way to make a decision. And then my last wrap up is, I get this asked all the time, Troy, are there other companies like yours out there? I have not found another mineral rights provider that sponsors mineral rights that does the way I do it. Why? They want to put them in partnerships. They want to put them in LLCs because they want to charge you any price they want to charge you, and they don't want you to control it, and they want to charge you fees afterwards, or they want to back in carried interest. I'm real simple. I'm going to buy it for $1. I'm going to pay my taxes, my cost of operation, and I want to make somewhere between 10 and 15% gross profit. That's my goal. And then I take my profit and I buy more minerals. My goal is to make a ton of cash flow to my investors because, one, you'll be my partner for the next 10 or 20 years, which they have been since 1985. Number two, you're going to make a lot of cash where you're starting to look at other asset classes saying, that's not as good as minerals. That doesn't make as much money. There's cost involved. There's liability involved. I don't see that with minerals. And the last thing is I think that it's a real simple measuring tool. If I can't measure my success by my partner's success, then I'm not successful. If I'm going to be in the business of handling investments for third parties like you, I've got to make you successful. That ultimately is what my trophy should say on my shelf, which is you are the #1 provider of the most successful investments in the oil and gas space to these investors, and here's your trophy. That's all I want when I'm done. Let's say we have 2 questions that popped up. One says, did I understand correctly, target returns are 10% with historical returns 18 to 20%? And the answer is yes. And then the second part of that question was, what price per barrel are assumed for these estimates? When we buy minerals, we buy it based on a commodity price, assuming in the last 2 years, $70 a barrel for oil and $3.50 for natural gas. But within that model, there's multiple different variables that we suppress that allows us to know that even if oil prices drop to $65 a barrel like last month, we're still going to meet and exceed that 10%. One of the things my team has been told is I would rather over-deliver and under-promise. So in that model, we don't control commodity price. We control where we buy, which is the operator in the oil company. We want to control the things we can control. But the one thing we don't control is commodity price. So we use $70 a barrel for, I think, the first 5 years, and we use $3.50 for natural gas. We don't calculate the value for natural gas liquids, which is a big, big boost to the revenue model. There's a lot of things we don't increase, but that's why we've been so successful, not only meeting, but far exceeding our revenue and our expectations on rates of return. The next question says, I think it's the same question been asked twice. It said, you have a target return for the investment. I already said we have 10% per annum. We're currently right at 18% cash on cash across 74 portfolios. So we're almost double what we projected, but I think we haven't even seen the beginning because keep in mind, in the first 18, 24 months of our portfolios, we're getting $45 oil and $1.75 natural gas. So if I were to use today's prices for 2021 in the beginning and 2020, we'd probably be closer to 27, 28% return. We look at the time we buy it, the condition of the minerals, the price we pay, and the overall, the way our financial model is, and that's how we make our buying decision. And that buying decision has been extremely accurate, which has allowed us to have the kind of performance that we do. The next question says, what are the risks investors need to be aware of? That is a great question, Sophie. Thanks for asking. Let me be blunt. Your #1 concern is I'm Leo DiCaprio, and catch me if you can. I'm a liar, a hoax, and a Ponzi scheme master. I'll tell you whatever you need to hear. Just give me your money. My #1 concern with any investment is who the person is. I don't care how good a deal you have. If you can't convince me you're the right person, I'm not giving you a dime. I don't even subscribe to a newspaper I see in the little paper boy's eyeballs, okay? The second thing that can go wrong is that we're completely incompetent. So yeah, we're honest. but we can't even win the lottery ticket. We'll trip and fall into a shredder before we get to the lottery winning circle, right? So it's competency. Well, we now, after 5 years of doing strictly mineral rights, we're at 74 portfolios. We have over 1,650 wells, 0 dry holes. We have currently almost 650,000 acres of reserves, and we have, I think, 1,120 sections of land, which is enormous. And at this point, we are meeting and far exceeding by almost a 2-to-1 our portfolio. So our track record, our experience, I've been doing this since 1985. I'm almost 60 years old. This is about a perfect storm of opportunity and expertise coming together at the same time. And I think I nailed everything right there. I hope.
You got it all. You got it all. Perfectly on time too. So, Troy, thanks again for the presentation today. Again, a reminder, on April 13th, we'll have a deal webinar, and we've got one more question here from Terry. Can investors invest qualified money?
Absolutely. You can invest in minerals in a self-directed IRA. It falls under real estate classification. And the good part about that is many of you probably have dormant or underperforming capital in your current IRA. One big component too that we found, a lot of our partners have moved from a traditional IRA. They've acquired minerals. There's 4 outside appraisers that will appraise those minerals, and they usually end up with like a 35 to 50% discount, which allows a maximum tax advantage when you roll it to a Roth. So I wasn't aware of that. One of my engineer clients looked at it 2 or 3 years ago, found an outside appraiser. Appraisal is about as thick as the yellow pages. So yes, qualified money, and yes, big advantage in taking and looking at that and then appropriately getting an appraisal. So it's IRS qualified, and then rolling that into your Roth with a big discount for taxes. And of course, the big concern right now would be is if we have the same kind of administration that wins in 2024, and they happen to win the House and Senate, they're going to push a lot of pressure on IRAs, 1031s, tax write-offs, capital gains. So I know a lot of my wealthy clients right now are taking advantage of this 18-month window, saying, play by the rules you know today, because they could change big time in November of 2024. So people are really moving money around with preparation of the what if factor. But that's a great question.
Similar question to the one that's been asked. What doomsday scenario, what does a doomsday scenario look like for investors, the downside risk? So anything you want to add to what Sophie had asked, if you want to add anything there?
Specifically to oil and gas and minerals, the only thing I could think of is that it's a House and Senate run by the Democrats, the White House is Democrat, and they come back and say, we're going to do an executive order. You cannot move a barrel of oil from private land across federal property, which means federal highways, right-of-ways, easements. Right now, what they've done, Obama did in his administration, was he cut off water. We need a lot of water for fracking. So he sent the EPA after water rights. Well, that was undone by Trump. So they knew that was a very limited effect. So what they did now is Biden has gone after capital. So this industry is capital constrained. When you talk about a doomsday scenario, quite frankly, I like that. Because the one thing I know is with real estate, if they attack minerals, they're also attacking your homes and your apartments, because it falls under the Constitution under real estate and private ownership. So I'm not worried about what they can do. They can just make the barrier to entry harder and more difficult, which is exactly why I want to buy minerals with producing property. Because if we've already got this many wells producing, they may slow you down in future drilling, but what you own is going to be worth $150 to $300 a barrel. And I've got all kinds of videos and training videos I've addressed on that on my app that you can go and look at. And my background is economics and finance. Oil and gas is my tool. My background is knowing numbers and knowing data. And I think when you take a look at it, it's empirically prophetic to say, whatever I own going forward, if it's tied to real estate and it's tied to oil and gas and minerals, that's going to be one of the safest investments I can own for the next 10 to 20 years.
All right, one more, and then we'll 2 more, and then we'll wrap it up.
Okay. I'll be short of my answer.
How do you qualify operators that want to license rights from you?
Well, first off, we don't do that because we buy mineral leases that are already leased. So they're already in place. The contract, XYZ oil company leased it 5-10 years ago, right? What we look at, and we like doing it that way because now it's a known factor, not a variable. We know what the terms are, what the conditions of the lease are, what percentage of royalty you have. So we look at first the operator on their performance and their ability to provide capital. So I can have the best operator in the world, but he can drill 1 well a year, not our guy. I don't want to have Exxon who has so much money that they take 2 years to pay you because they just don't care if you're mad at them and they won't answer the phone call. So there's a combination of operator being the right size, the right performance, the right capital. And then once we know that we like that operator in the right spot, then we look at the lease terms and make sure, is the lease that the person signed 5 or 10 years ago, who's probably not sophisticated, did they sign a lease that's good or bad? If it has terms that are not so favorable, then we discount what we pay by those terms. We discount it like you would a piece of real estate. If it had a cracked foundation or something's wrong, you discount your price. We like to stay away from discounts. We like to get premium AAA minerals with AAA operators. There's too much opportunity to do that, to buy what I call subgrade or less than AAA quality. And the last one is, how do I sign up for more information? Look, first thing you need to know is we don't have any commission salesmen. We sell nothing through broker dealers. We have no outside financial planners that get paid a fee. No one. I did that. I had a brokerage firm for 22 years. I've got 5 wealth managers. They're paid a salary. You invest $25,000 or $25 million, they get paid the same. I want them to manage your account. So what you do is go to EckardEnterprises.com, or go to www.eckardlandandacquisition.com, or go to the Eckard Insights app, 3 ways, and you fill it out and say, I'm accredited, I'm not accredited, I'd like more information. One of the wealth managers is going to call you. I train with them every day. Every morning they get trained from 8:15 to 9:30 on what's going on in the market and minerals. I want the most sophisticated, hand-holding, customer-serving driven people. You think I'm a maniac the way I talk fast? You should work here at this office. I outwork 35 people because I want you treated the way I'm treated. So if you want to sign up, go to the app. If you want to email me directly after this, I'll get you to wealth manager. It's teckard@eckardenterprises.com. My cell phone is 469-422-1781. I used to get 5 texts a day. Now I get hundreds of texts from partners about their portfolios, their apartment deal falling apart, what they think about gold. Because why? You're not a partner because you're in a partnership. You're in a partner because when you agree to be an investor with me, I'm going to treat you like I want to be treated as a partner. I answer the phone 24/7. My staff answers the phone. I love what I do, folks. I'll be 60 years old. You think I was 25 years old, except I'm really getting crusty and gray hair and I'm losing hair. Other than that, I'm doing good.
Perfect. And
yes, sir.
Terry, thanks for the question. We wouldn't want to wrap up without getting information on how to connect. So again,
Appreciate that.
We'll get the recording posted to the website or out in an email and to our YouTube channel. And then another quick pitch for April 13th at 2 Eastern. We're going to have Troy back on to talk more deal specifics. In the meantime, if you reach out, make sure you mention you're with LFI. And otherwise, we will see you on the recording or on April 13th at noon Eastern or at 2 Eastern. Troy, again, thanks for your time. I appreciate your patience with the tech. Go ahead.
I want to say one parting thing to all of your members. I want you to hear this from the bottom of my heart. This is going to be chaos. Don't get rattled by it. Focus on what's going right. Don't get rattled by what's going wrong. Focus. This is not the first rodeo this economy's been through. This is not the first banking mess we've been through. I've been going around the country telling my partners this. Look, for one thing, we're all blessed. Everybody on this particular meeting has money, access to money, a good job, good paying job, or you wouldn't be on it. You have money to invest. We're in that top 1 or 2, 3%. So I'm telling my partner, don't get stressed. Don't let your health go to hell in a handbasket. Spend time with your family. Because the reality is, it shows, and it's groups like Left Field that are going the extra mile to bring you the very best information and education and access to assets. And because of that, we will weather the storm very, very well. But also don't be naive. Don't sit around and think that everything's good and over. It's a pretty big mess coming toward us, but we can navigate it together successfully. So I wish each one of you a great week, great success. Thanks for having me on. If you ever need anything from me, just let me know. Otherwise, I'll see you on the 13th with a product-specific conversation. Take care, everybody.
Appreciate it, Troy. Thanks, everybody.
Thank you, sir.